In the middle of 2016, the United Kingdom voted in favour of leaving the European Union, and a few hedge funds leveraged the vote to make hundreds of millions of dollars. This is the minute-by-minute value of the sterling pound on the day of the referendum, and within this data lies the shady and legally questionable ways they achieved it.
The polls have closed.
We've spoken to Nigel Farage, the leader of UKIP. Turnout looks to be exceptionally high and looks like Remain will edge it.
When voting closed at 10 PM, pollsters were now legally allowed to share their exit poll predictions publicly.
We now expect that the United Kingdom will remain part of the European Union.
The public was hearing this for the first time. But hours earlier, YouGov sold their results to a hedge fund for $1 million. Their Remain in the Union prediction on Sky News caused an increase in the pound, and the firm that bought the data made huge profits from it. But this is honestly just the tip of the iceberg, because YouGov's poll was actually wrong.
Well, at 20 minutes to 5, we can now say that we are absolutely clear now that there is no way that the Remain side can win.
And when the outcome became clear, hedge funds made a ridiculous amount of money. Let me show you how these hedge funds knew every little price movement before it happened, and how a key political figure of the Leave movement was allegedly involved in the scheme. The 2016 referendum was a defining moment for the United Kingdom. They joined in 1973 in what was then called the European Economic Community, but it was always a kind of half-in membership. When the EU began developing its new monetary system, the UK opted out. The euro currency used by most member states was founded in 1992, and the UK chose to maintain their own currency. The movement for severing ties with the EU gained momentum in the early 2000s. And in 2013, Prime Minister David Cameron gave a speech at Bloomberg.
It is time for the British people to have their say.
When his Conservative Party won the 2015 election, they passed the EU Referendum Act to set everything in motion. This is about as much history as I'm going to give on Brexit, because frankly, it's just not that relevant to this video. What is relevant is that you hit the subscribe button. No, but the critical piece is that these kinds of economic shifts are extremely rare, and they're also a dream for hedge funds. O'Day Asset Management was one of the investment firms which made hundreds of millions of dollars from the Brexit trade. A year before the vote, the firm was managing almost $12 billion for clients, with many of its big successes coming from betting on particular assets declining in price, such as shorting the stock of banking companies in 2008 and the decline of the sterling pound. One of the widely agreed consequences of the UK leaving the European Union would be that the pound is likely to decrease relative to other currencies. Goldman Sachs research showed that it could cause as much as a 15 to 20% drop compared to the US dollar. The expectation was that the UK separating would raise the risk of investing in British companies, and therefore investment flowing from other countries would slow. Less people buying the pound causes a lower price. But if the outcome was to stay in the EU, the pound would avoid a crash, and maybe even strengthen after the many years of growing economic uncertainty. O'Day Asset Management began working on a trading strategy. If they could know for sure which way the referendum would go before everyone else did, they could profit from trading in the currency. But they actually figured out something even better. O'Day and a handful of hedge funds found a way to make money at every stage of the vote, without needing to know the outcome. An insider trading loophole that made accessing non-public information kind of legal. Like, sort of. Maybe. And it was only possible because of a controversial decision made by Sky News, the BBC, and other media outlets. A scheme that led to the investigation of one of the political leaders at the centre of the vote. It's all very shady. But what about the average investor? What are some legal ways we can gain an edge in markets? Top investors legally gain an edge by focusing on 3 key pillars: superior information, sharper analysis, and disciplined execution. And the best toolkit for achieving all 3 is Investing Pro from investing.com, today's sponsor. I can easily track my watch list and investments, see fair value estimations, and add my own price targets so I know when to pull the trigger. There's an ideas tab for taking a peek at what the famous famous investors are buying, or even themes like founder-led companies. And you have an investing oracle at the tip of your fingers with their new Warren AI feature, the ChatGPT of investing, backed by investing.com's real-time data, the best data in the market. You actually have no idea how much time this saves. Just ask Warren to analyze your portfolio, and in an instant you can spot winners and drop the duds. And this is really just scratching the surface. I haven't even mentioned half of Investing Pro's features. So if you want to learn more and try it yourself, they're having a ridiculous 50% off sale at the moment, and just for my audience they've bumped that up to 65%. It's only for a limited time, so click the link in the description or scan the QR code to get started today. Using tools to synthesize data is of course one way that investors can gain an advantage, but this video is about something much more in the ethical grey area, gaining an advantage by using non-public information. In the months leading up to the vote, the outcome was highly uncertain. Some polls had the Remain vote in the lead, others were showing Leave the EU. But for the most part, the opinion polls indicated that the race was much too close to call. The value of the sterling pound in early 2016 also reflected this sentiment. As low as $1.40 in January, then up to $1.46 by February, back to $1.38 in March, and back up just weeks later. But it's hard not to notice the very obvious trend. The pound was progressively rising as the June referendum approached. In spite of the tight polling data, the media narrative was swinging towards the UK staying in the European Union. The betting markets really drive this point home. Even as voting closed at 10 PM on the 23rd of June, Betfair was offering 10-to-1 odds of a Leave the EU outcome, predicting a more than 90% chance of remaining. As the votes were being counted, the pound continued to remain resilient. And that's in part because of exit polls, or in this case, the lack of exit polls. If a pollster like Comres calls you up a week before the referendum and asks you how you intend on voting, that's an opinion poll. But on the day of an election, they'll also survey people after they've placed their vote, an exit poll, which should give a more accurate projection because the respondents have already decided. Emphasis on the should. Obviously, it's not always the case. The UK has strict laws around this. It's actually illegal to publish any exit poll data before the voting has concluded. But during this referendum, the exit polls weren't broadcast at all, even after the ballots closed. The BBC, Sky News, and other media outlets met with pollsters and decided that creating an exit poll wasn't possible in this referendum. Chief designer of UK's broadcast exit polls, John Curtis, said his predictive models relied on a comparable vote, and for Brexit, there was none, making a credible exit poll an expensive and difficult proposition. Too expensive for a broadcaster like the BBC, but not too expensive for a hedge fund. Over at Rokos Capital Management, this news was better than anything they could have imagined. The hedge fund's founder, Chris Rokos, got on the phone and dialed the offices of polling company ICM. He wanted them to make an exit polling model that he could use on the day of the vote to assess the direction of it. ICM commissioned John Curtis himself for the project. Curtis would design the model and ICM would conduct the poll on referendum day, feeding the stream of data directly to the Rokos hedge fund while votes were being cast. They'd have access to the best estimation of the vote's outcome, all while the public were completely in the dark. And they'd get the data many hours before polling even closed at 10 PM. UK's strict exit polling laws, that carry a 6-month sentence by the way, only prohibit making the data available to the public at large or any section of the public. Since Rokos was simply buying the data for their own private use, it fell into a legal grey area. At the time, there'd never been a criminal case to assess whether or not the private sale of polling data in this way was legal or not. The question for pollsters was just how deep they were willing to go into the grey area. YouGov, which I discussed in the introduction, were cautious and only sold their exit poll data to one hedge fund. For $1 million, mind you. But on the other end of the scale, you had a poll company called Survation. They ran exit polls and sold the data to multiple clients who remained anonymous. Comres sold their data to Brevin Howard, one of Europe's largest hedge funds. And Bloomberg found 2 more hedge funds who bought YouGov's pre-election data, Capstone Investment Advisors, and O'Day Asset Management. Also, it's very likely there are many other hedge funds who were also involved in this. A lot of the information we do have was uncovered in Bloomberg's brilliant investigation, so all the credit goes to them. As the votes were cast on the 23rd, these hedge funds received live updates, and it showed that the vote was significantly closer than market sentiment was suggesting. Survation's polling actually projected the result would be to leave the EU. If this turned out to be correct, then betting on the sterling pound declining would be extremely profitable. Hedge funds began taking aggressive short positions against the currency. They were able to continue building these bets all the way until even after voting had closed. After about 2 hours of vote counting, the public was finally becoming aware of what hedge funds had known for hours. At 12:16 AM, the city of Sunderland revealed a 61.3% vote for leaving the EU, much higher than the 53% predicted by opinion polls. The sterling pound plummeted. After peaking around $1.50, it fell to just $1.43 in 2 minutes. In the early hours of the 24th, the referendum was called in favour of leaving the European Union. The pound slid as much as 10%, reaching a low of $1.32 at 5:30 in the morning. Brevin Howard made $160 million on the 24th alone. O'Day Asset Management's founder personally made roughly $300 million. Capstone around $100 million. But most interesting of all was Rokos. The exit polling data they purchased from ICM incorrectly indicated that the US would remain in the EU, but they still made about $100 million in a single day. How is that even possible? Well, getting the exit polling data before everyone else isn't just about trying to predict the outcome. Having a live feed of data meant Rokos could bet on the small swings in prices every step of the way. They are looking for a slight edge. They don't expect you to be 100% accurate. Put simply, the public had no access to exit polls that could give greater insights on how each region of the UK were voting. Rokos didn't have perfect insights, but their data was generally more accurate. They just had to consistently bet based on their model, and on average, that was extremely profitable across the night. But this story actually isn't just about polls. There's an aspect to this whole saga that involves a lot of weird coincidences, all centered around Nigel Farage. Farage was the leader of the UK Independence Party and a leading political figure in the campaign to leave the EU. He also happens to be friends with Damien Lyons-Lowe, the founder and CEO of Survation, the polling company whose exit poll correctly predicted the leave outcome, and sold that data to numerous hedge funds during the referendum. Farage made not one, but 2 public concessions after the voting closed. The first on Sky News just minutes after 10 PM, and again just 70 minutes later. Remember, at this time, the public had absolutely no idea which way the vote was going to go. The margin was reportedly less than a couple of percent. That alone is strange, but it's even worse when you consider his pollster friend at Survation was confident in the opposite result. Farage later claimed that he only learned about Survation's data after he made the first concession, which still means he made the second concession fully aware that the result was likely to swing in his favour. But it gets worse. When Bloomberg's journalists pressed him about whether he got the data before 10 PM, he said, "That would have been, for he and I to have spoken ahead of 10 o'clock, that would have been wrong at every level. Wrong for me, wrong for him, just would have been wrong." He's right, it would have been unethical and possibly even illegal for Survation to share the data before the polls closed. Well, according to 2 different accounts from members of his own team, Farage was clued in at 9:40. While certainly speculative, you don't have to be a genius to connect the dots. You could certainly say it looks like Farage deliberately misled the public to temporarily boost the pound, helping hedge funds to profit more from the eventual downturn. There's also that YouGov poll from the introduction. A 52 to 48 prediction is certainly too early to make a definitive call, and yet their head of political research was happy to state that they expect the UK to remain in the EU.
We now expect that the United Kingdom will remain part of the European Union.
The statement caused a pretty meaningful rise in the pound, at the exact same time as 3 of YouGov's researchers sat in the offices of a hedge fund who paid them $1 million for their non-public data. I'm not a conspiracy theorist, but clearly that's a conflict of interest. They have every financial incentive to provide the most accurate data to their client while nudging the market sentiment in the other direction. You might hear all of this and say, so what? Some hedge funds bought some private data and more accurate modeling. How is that even illegal? And you're not wrong. It's certainly not a breach of any insider trading laws. Trading on non-public information is only illegal if a fiduciary duty has been breached. If a company was selling a hedge fund early access to their financial report, that would clearly be a breach. But nothing about the Brexit vote is related to corporate information. The exit poll data, while not available to the public, is simply about market sentiment. But there is definitely an ethics debate to be had. In 2018, the chair of the Treasury Select Committee wrote to the British Polling Council, hoping to reform rules around polling data. He argued that the practice of selling private polls to hedge funds could undermine the public's trust in election polls, and that it creates an incentive for polling companies to publicly provide misleading data. The Polling Council declined to adopt any of the proposed improvements in transparency. The Financial Conduct Authority also chose not to pursue any firms. There's also been no changes to regulations, and so technically this loophole still exists. A reminder to check out investing.com, click the link in the description to get an extra 15% off your first Investing Pro subscription.